Good morning, and welcome to the PCAOB Inspections Update on broker-dealer engagements. My name is Greg McCune. I'm an Associate Director in the Division of Registration and Inspections. With me is Mike Walters.
Yes, good morning, Mike Walters, Charlotte, North Carolina, also a firm coordinator in the broker-dealer inspection program. Both Greg and I have been with the temporary broker-dealer inspection program since close to the beginning of the program. So we've been able to present at a number of these forums. Thank you for attending. We're looking forward to our remarks today, and we welcome your questions. Our disclaimer, views expressed are in our official capacity as members of DRI and are our own and do not necessarily reflect the views of the board, any individual board member, or other members of the staff. And the first view that I wish to personally express is appreciation for Board Member Calabria's remarks and the newfound momentum that seems to exist within the board towards the eventual determination of the scope of a permanent inspection program. And those of us on the inspection team look forward to working with the board when called upon to help inform that ultimate determination. I personally feel like all the work we've been doing for the last 10 to 15 years is to help inform that ultimate determination. So we look forward to hopefully seeing that come to its successful conclusion. With that, here are our objectives for today. Really three broad topics, and as we traditionally do, like to cover our most recently available published inspection results. Those happen to be from the 2024 inspection period. You can look forward to the publication of our next round of results, hopefully in July of this year, covering our 2025 inspection activities, but most of what we'll speak about today is from 2024. We also want to highlight some other sources of information, publications that are available to help you in the conduct of broker-dealer engagements. And we'll give a little bit of update on where we are with respect to 2025 and 2026 near the end. With that, it's always helpful for us to know the audience at the forums. We know there's a mixture of issuer and broker-dealer engagement participants out there. So if you don't mind, just a quick show of hands of those of you who are involved really in any way in the conduct of broker-dealer engagements, if you wouldn't mind. I'm not going to call anyone out. That looks like, okay, maybe 2/3. Don got his hand up late. I saw you, Don. Roughly 2/3, that's great. And if you would indulge me one step further, of that group, those of you who have any involvement in the audit of a compliance report filer versus exemption report only, I would expect that to be smaller, maybe 7 or 8 hands. Thank you for that. That certainly our presentation as a whole is focused on the exemption report community, I would say, but we do have some content specific to AT1 and compliance report filers sort of towards the end, and glad to see that we have some participants here who are involved in those engagements, and hopefully that content will be relevant for all of you to an extent. Shifting into our first topic, that being inspection observations, we've organized around 5 broad categories here. Greg and I are going to tag team these 5 topics. Why these 5? It's pretty simple. If you added these up based on our most recent published inspection findings, these topics collectively constitute the vast majority of identified deficiencies for the respective inspection period. So it only makes sense that we spend time focusing on those topics and hopefully giving helpful information about the nature of those findings and things we can do collectively to prevent those in the future. Our approach will be to briefly summarize the general nature of the deficiencies that we commonly see, and then we'll have a series of very short exercises along the way to help reinforce some of the points that we will make around each of those topics. And with that, I'm going to turn it over to Greg to begin our discussion for revenue. However, before we do that, let's cover our first CPE code. We'll make sure I've allowed time for people to check in and be able to input the first code for this session, which is 340. And I'll pause a little longer on the first one here to give some extra time. So please raise your hand if you need another moment. But 340 is our first CPE code for this session. And with that, I will turn it over to Greg.
Okay, thanks, Mike. So with regard to revenue, we'll begin with some inspection observations related to revenue, and the topics we'll cover will include sharing some statistics from our inspections and provide some insights regarding deficiencies at the assertion level. Then we'll have a couple of short scenarios covering reliability of evidence and revenue recognition. Next slide. So you can see from the graph here that revenue is the most problematic area identified during our inspections. In 2024, we looked at revenue on 97 engagements, so not every engagement, but virtually every engagement. And the error rate was 48%, so almost half of all the engagements we looked at had a deficiency related to revenue. The revenues deficiencies were observed across different areas, including commissions, investment advisory fees, 12B1 fees, merger and acquisition and other advisory fees. Common deficiencies included auditors that did not adequately respond to the risk of material misstatement for each relevant assertion of significant revenue accounts and disclosures in accordance with AS 2301. We saw audit sampling deficiencies under 2315. Specifically, we see a number of instances where engagement teams are just picking a sample size based on judgment without taking into consideration tolerable misstatement, the allowable risk of incorrect acceptance, and the characteristics of the population that's being sampled. Another area that we've seen deficiencies is in the use of substantive analytical procedures under AS 2305. We still see a number of firms that will just be doing a very basic fluctuation analysis comparing current year to the prior year without really any other consideration of the requirements under 2305. Another code?
Almost back-to-back code words here. So 553 is your next CPE code, 553.
Okay, so we're going to talk a little bit about financial statement assertions. And just to refresh on that, AS 2301 requires that auditors design and perform audit procedures in a manner that addresses the assessed risk of material misstatement for each relevant assertion of each significant account and disclosure. Just to refresh on what the assertions are, in AS 1105, the PCAOB identified 5 assertions: existence or occurrence, completeness, valuation or allocation, rights and obligations, presentation and disclosure. Some firms use different variations on that, as long as the substance of the assertions is pretty much consistent with that. We don't take exception with that. A lot of firms still use the old AICPA assertions, which are very similar, and that tends to be fine. Most of the deficiencies in the revenue area related to firms that did not adequately respond to the risk of material misstatement for each relevant assertion of significant revenue accounts and disclosures. Of the assertions discussed in the prior slide, presentation and disclosure and valuation and allocation were 2 assertions that were commonly cited in deficiencies. Examples of deficiencies include firms did not test whether trade amounts and commission rates were accurate, which is valuation or allocation. Firms did not test whether assets under management and fee rates were accurate, again, valuation or allocation. Firms did not evaluate whether revenue, such as variable annuity, trail commissions, and 12B1 fees that were reported as commission revenues should have been disaggregated into categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors, which is a presentation and disclosure consideration. and firms did not evaluate whether appropriate qualitative information about the performance obligations was disclosed, including the timing and nature of the services rendered and the satisfaction of performance obligations. Again, presentation and disclosure. So we're going to go through a little bit of a scenario here, and we'll have a polling question tied to that. So just quickly, the scenario is, and this is regarding the reliability of evidence. So we've got, it has to do with 12B1 fees. We have an introducing broker that offers mutual fund investments and uses a reputable clearing broker for trade processing. The clearing broker calculates and remits 12B1 fees to the introducing broker based on the average net asset value and the applicable fee rate, and reports the 12B1 fees to the introducing broker in monthly clearing statements. The engagement team determined that there was a fraud risk related to revenue recognition for 12B1 fees and assessed the control risk for 12B1 fees as high. And for a sample of 12B1 fees, the engagement team recalculated the monthly 12B1 fees based on the daily average net asset value and the fee rate obtained from the mutual fund prospectus. In certain cases, the revenue deficiency was a function of the reliability of evidence the firm obtained to support the revenue balance. Let's walk through an example using this 12B1 fee scenario. So we've got a polling question here. Which of the following provides the most reliable audit evidence to support the NAV? Is it A, monthly customer account statements produced by the clearing broker? B, an internal spreadsheet prepared by the broker-dealer? C, a clearing statement from the clearing broker which shows detailed 12B1 fees? D, any of the above? So we'll give you a few seconds there to think about that and respond.
Yeah, monitor.
Sorry.
Trying to figure out what our magic number should be. Let's see, we're at about 30, low 30s. 35. Going once, going twice. Let's see if this works. Oh, 37. We got a couple in.
Okay. So it looks like
C was the most popular.
right. C was the most popular. And actually, the correct answer is A.
Second most popular.
Right. So we'll go through the why A is the correct answer and why the other ones are not. So AS 1105, paragraph 8 states that reliability of evidence depends on the nature and source of the evidence and the circumstances under which it is obtained. Evidence obtained from a knowledgeable source that is independent of the company is more reliable than evidence obtained only from the internal company sources. Under certain circumstances, a clearing broker may be considered a reliable external source in an audit of an introducing broker. Factors that the engagement team considers when evaluating the reliability of information obtained from a clearing broker may include, but are not limited to, the relationship between the introducing broker and the clearing broker, the audit evidence obtained from the clearing broker that originated from the introducing broker, and the extent of regulatory oversight of the clearing broker. In this scenario, the net asset value included in the customer account statements produced by the clearing broker can be used as a form of evidence that the auditor inspects when performing its substantive procedures over 12B1 fees, as this information originated from the clearing broker-dealer, which can be considered an external source. An important factor related to determining if the source is reliable is related to the extent of regulatory oversight of the external source. Information from external sources that are subject to regulatory oversight or statutory mandate typically undergoes rigorous verification processes and would likely be considered more reliable than information from external sources with little or no oversight or statutory authority. To put this into context, this would refer to financial responsibility rules that the clearing broker is subject to, as well as the FINRA rules, specifically FINRA Rule 2231, customer account statements. So let's go into why the other answers are not correct. So answer B is not correct because the the internal spreadsheet is not an external source, rather is information produced by the company. In that case, to use the information as audit evidence, the engagement team would evaluate whether the internal spreadsheet is sufficient and appropriate for the purposes of the audit by performing procedures to test the accuracy and completeness of the spreadsheet in accordance with 1105, paragraph 10. Answer C is incorrect because the engagement team cannot rely on the clearing statement as audit evidence for the net asset value without performing additional procedures. Contrast the use of the customer account statements in response A with the clearing statement in response C. Considered the following factors. Monthly commission and fee reports issued by the clearing broker, not to be confused with the customer account statements, are the result of transactions that originated from the introducing broker-dealer. Certain small introducing broker-dealers use these monthly clearing broker statements as part of their official books and records under Rule 17A3 and 17A4. These contrasts need to be considered when assessing the relevance and reliability of the clearing broker statements as evidence under AS 1105. Furthermore, AS 1105 states that if a third party provides evidence to an auditor subject to restrictions, limitations, or disclaimers, the auditor should evaluate the effect of those restrictions, limitations, or disclaimers on the reliability of that evidence. In our experience, such restrictions, limitations, or disclaimers are at times existing with respect to clearing broker statements. And then, so since A and C are incorrect, A and C are incorrect, obviously D would not be correct either. Okay, so let's take a couple of variations on this scenario. Let's slightly tweak the facts in the scenario to highlight how changes in the risk assessment can impact the reliability of audit evidence. We want to highlight that the appropriateness and sufficiency of audit evidence is dependent on the auditor's professional judgment and the overall risk assessment. So in the first adjusted scenario, if the engagement team took a controls reliance approach and used controls effectiveness at the service organization to support its conclusion regarding the reliability of information produced by the service organization, the service auditor's report should be obtained and evaluated. Footnote 3 of AS 1105-10 refers the auditors to AS 2601 when using information produced by a service organization. As part of this evaluation, the auditor should determine whether the specific tests and controls over the accuracy and completeness of information contained in clearing statements results in the auditor's report are relevant. In scenario 2, let's say we tweaked it by saying the engagement team assessed the overall risk of material statement as low, meaning there's no fraud risk or significant risk. The auditor may place greater reliance on clearing statements as audit evidence for the net asset value. However, the auditor would still need to evaluate the reliability of the source, such as evaluating the clearing broker's reputation and knowledge. In the context of clearing broker audits, in the context of broker-dealer audits, this guidance would apply to audit evidence provided by the clearing broker when auditing the introducing broker, since the clearing broker would be considered an external source. Specifically, I'm referring to, there was PCAOB staff guidance issued in October 2021 that provided guidance on evaluating relevance and reliability of audit evidence obtained from external sources. So we'll go on later in the presentation. We'll talk some more about some of the PCAOB materials that are out there that can help you in your audits of broker-dealers, Okay, next area we want to talk about is revenue recognition, specifically cash and non-cash consideration. So we want to talk about a scenario where we have these facts. The broker-dealer was engaged on May 1 to perform underwriting services for a customer on a best efforts basis. Broker-dealer accounted for the contract as a single performance obligation to raise equity capital for the customer. The broker-dealer satisfied its performance obligation when the equity securities were sold to investors on July 1, which was the trade date. And as compensation for its services, the broker-dealer received both cash and non-cash consideration in the form of warrants to purchase shares of the customer. So based on that, which of the following statements would best describe the appropriate revenue measurement and recognition? Would it be A, estimate the fair value of warrants at the inception date of the underwriting contract? B, recognize the estimated fair value of the warrants in cash received as of the trade date? C, defer the recognition of the fair value of the warrants as revenue until the warrants are sold by the broker-dealer? Or D, both A and B? So I'll give you a few seconds to respond.
few more seconds. See if we get to. May not get those last two this time. All right, we'll close the poll.
So it looks like,
B followed by D.
okay. Well, the correct answer is D, both A and B. So those who guessed A or B got partial credit for that, but the best answer is D. Both A and B are accurate statements in accordance with the measurement and recognition requirements of ASC 606. In accordance with 606-10-32-1, when a performance obligation is satisfied, the broker-dealer should recognize as revenue the amount of the transaction price that is allocated to that performance obligation. In this scenario, there was only one performance obligation to raise capital for its client that was satisfied on the closing date of the equity offering. And as such, the combination of cash and estimated fair value of the non-cash consideration would be recognized at that time. Pursuant to paragraph 606-10-32-21, to determine the transaction price for contracts at which a customer promises consideration in a form other than cash, an entity shall measure the estimated fair value of the non-cash consideration at contract inception. That is, the date at which the criteria in paragraph 606-10-25-1 are met, which in this case would have been May 1. So answer A is partially correct, answer B is partially correct, and then answer C is incorrect because there's only one performance obligation to raise capital for the client that was satisfied on the closing day of the underwriting transaction. As such, the broker-dealer would recognize the total transaction price as revenue upon the satisfaction of the performance obligation on the trade date. Okay, so now we have a question on recognition of merger and acquisition advisory fees. So the facts are a broker-dealer's primary business is to provide merger and acquisition advisory services to institutions. The broker-dealer uses a standard customer contract which identifies services to be performed in payment terms. The broker-dealer generally provides one or more of the following services to customers. One, developing strategies and assisting the customer in preparing financial forecasts and analysis, providing research and analysis on potential targets, providing fairness opinions, providing strategy and negotiation assistance, and assisting with communications regarding the transaction. So with that, we've got the next polling question. Which is the most significant factor in assessing whether there are separately identifiable performance obligations in a merger and advisory services contract under ASC 606? Is it A, the contractual payment terms, B, whether a service is distinct within the context of the contract, C, whether a service is provided over time or at a point in time, or D, whether the advisory services are refundable? So again, we'll take a half a minute or so.
A few more seconds. 36. Can't get that 37th vote. All right, we'll close it. Here we go. B is the most popular answer. Greg?
And B is the correct answer. The auditor should evaluate the terms of the broker-dealer's merger and acquisitions advisory contracts to understand the nature of the services to be provided. The BD should consider whether each service is capable of being distinct and is distinct within the context of the contract in accordance with paragraphs 19 through 22 of 606-10-25. So for example, the task of providing due diligence services could be considered capable of being distinct. However, an arrangement in which the customer engages the BD to broker the sale of a business, the BD should evaluate whether those due diligence services are distinct in the context of the overall contract. One factor to consider whether the promise to provide a service is distinct in the context of a contract is whether that service is highly dependent on or interrelated with other services that may not be separately identifiable. Another factor to consider whether otherwise distinct services are substantially the same and transfer to the customer over time under the same method of measuring progress. Then the PD would account for those services together as a single performance obligation. This could be the case, for example, when the promise is to provide consulting or advisory services over a period of time and the criteria for recognizing revenue over time has been met. A fairness opinion may need to be accounted for as a separate performance obligation based on the criteria in 606-10-25-19, because the opinion could be obtained for another, if the opinion could be obtained for another BD outside the advisory contract, and the opinion and the advisory services are not highly interrelated. So we'll go over why the others were not correct. Answer A is not correct because contractual payment terms help determine the transaction price, which is the next step in the 606 revenue recognition. But after performance obligations have been identified, separate fees are for separate services in an advisory contract may be relevant in assessing whether services are capable of being distinct, but alone does not constitute a separate performance obligation. Answer C is incorrect. Whether services are provided at a point of time or over time is a factor in determining the appropriate revenue recognition for a performance obligation, but does not dictate whether performance obligations are separate. And answer D is incorrect. Refundability of fees is a factor to consider when determining whether the transaction price includes variable consideration, but is not part of the process for determining the separate performance obligations in a contract. And just to remind you, the criteria for revenue recognition under 606 include identifying the contract, identify the performance obligations, determine the transaction price, allocate the transaction price to distinct performance obligations, and then recognize revenue when performance obligations are satisfied. Okay, and with that, I'm going to turn it over to Mike to talk about related parties.
All right, thanks, Greg. We start with revenue because revenue, far and away, is the most frequently reviewed financial statement focus area on our inspections. We didn't present this equivalent slide for revenue because essentially all of the time we choose to include revenue in the scope of our review. That's different for the remaining financial statement topics we'll talk about. So for example, here on related parties, and again, this is 2024 data, but in 24 we reviewed 102 audits. 28 out of those 102 we chose to scope in related party transactions, and within those 28 we found 10 instances of at least one deficiency that we communicated to the firm. But related parties is right there in terms of the second most frequently reviewed topic and area for which we find deficiencies. You may or may not be surprised to hear that many of the deficiencies that we do identify relate to testing related party transactions that have been identified and disclosed. So this is, in this particular case, this is less about the procedures you need to do to identify related parties and related party transactions that the client hasn't identified for you and properly disclosed in their financial statements. But I think those who are BD auditors hopefully would agree that these is not uncommon at all to encounter related party transactions that are in fact material for a given broker-dealer client. Those can be revenues or expenses, certainly other items on the balance sheet. Much of what we're going to talk about today does involve revenue and expense-related related party items. And generally this is involving the parent or one or more affiliates, and often involves scenarios where there's some form of an expense sharing arrangement, a management services agreement of some type, or some sharing of revenue because the broker-dealer is involved in the distribution of a certain product that maybe is sponsored by or issued by another entity. So on the left side, these are broad categories of deficiencies that we've encountered recently on inspections. First, really not testing the allocation of revenues or expenses at all. We see that from time to time. Or more specifically, not evaluating whether allocated revenues or expenses were consistent with the terms of the applicable agreements, such as those that I just mentioned. Not evaluating the financial capability of the related party to satisfy a material uncollected balance. Do see this from time to time. Oftentimes it's a receivable from the parent, and you look at the broker-dealer's reported results over time, and that receivable it continues to grow. It never seems to be settled, and at some point raises the question of collectability there of that recorded receivable. Of course, the disclosure of these transactions is an important consideration for us on inspections, and we do have instances of not identifying omitted or perhaps inaccurate disclosures of related party activity. In particular, whether the disclosures are necessary or sufficient to understand the effects that those transactions have on the broker-dealer's results. And then, and those would be subject to the requirements of ASC 850, those disclosure requirements. Finally, our standard, AS 2410, does include some specific communication requirements with audit committees of the broker-dealers, and these are separate from the general audit committee communication requirements that are part of ASC 1301, and we do from time to time encounter firms that sort of just fail to take into account the fact that AS 2410 has its own set of communication requirements to the extent applicable to audit committees regarding how the auditor has evaluated that related party activity. Good practices in this area, I don't think these are particularly innovative, but various forms of guidance that we've seen firms implement, in particular when that guidance specifically contemplates how to approach an expense sharing arrangement or a situation where costs are being allocated from one entity to another. Find that to be particularly helpful and seems to help engagement teams effectively deal with risks associated with this topic. Of course, appropriate financial statement disclosure checklists and audit committee communication checklists that take into account communication requirements in other PCAOB standards beyond AS 1301. And of course, training can help in this area, particularly when it covers both PCAOB auditing standards requirements, but also the corresponding GAAP requirements in this area, which again is ASC 850. Also, there's some regulatory specific guidance that I'll just introduce here. We'll speak about it in a little more detail in a moment. That's FINRA Notice to Members 0363, which perhaps rings a bell with some of you in the audience. That has a little bit of relevance in terms of the scenario that we're about to walk through after we input our next CPE code. So that is 583. 583. And with that, let's advance to our scenario. So these will work same as the ones that Greg worked through here. All right, so in this case, we have an expense sharing agreement. All right, the broker-dealer is a FINRA member, and there's an intercompany expense sharing agreement between the parent and other affiliates where certain expenses incurred by the parent are allocated out to the BD and those other affiliates. The expenses are initially recorded in the parent's GL and then allocated out based on the methodology that's established through the agreement. The engagement team did determine that there was a risk of material misstatement associated with these particular expenses subject to this agreement. So we have our polling question here. All right, so what would be the best audit response with this limited set of facts that we gave you? A, obtain the intercompany expense sharing agreement and inquire of the broker-dealer regarding the allocated expenses. B, Evaluate the expenses recorded by the parent that were subject to the allocation. How about C, evaluate the reasonableness of the allocation methodology, whether it was accurately applied. Or D, a combination of the above procedures. I have great optimism for these responses. Let's see. Let's see if that's founded or unfounded. 36. Can't get number 37. I don't know what's going on. Wow, 38, a new record. Haha. Beat you, Greg. And
That's because I voted.
I don't know why Greg has particularly difficult polling questions, but mine, great job here. We've got 97% of you with all of the above. Always a good, even if you didn't know, it's a pretty smart guess, right? So a combination of the above procedures, and I think that is the best answer here. Why might, let's see, where's A? So just to comment on each response, why might A be insufficient? Well, A is essentially limited to reading the document and inquiries, and there's some language in 2410 that makes reference to other PCAOB standards that indicate that inquiry alone would not be sufficient to address the risk to an acceptably low level for a material account or disclosure. So A is probably not best. B, evaluate the expenses recorded by the parent that were subject to the allocation methodology. I do think this is a good and appropriate procedure to perform in the fact pattern that we laid out. However, what I want to be clear about is what we are not saying is that, well, because I'm auditing the broker-dealer, that somehow I'm also responsible for auditing the parent's books and records as if I was also the auditor of the parent. That's not what we're trying to say here. But it remains the case that generally these classes of transactions are governed by formal agreements between the parties that have specific terms, often methodologies that are laid out. They cover certain specified categories of costs most of the time, at least in my experience. And so there is an opportunity and there are risks associated with whether or not those agreements are being adhered to. So there are procedures that you can perform, I think, that are reasonable and appropriate without having to audit the parent's books and records. You can certainly look at period over period, the nature, not only the amounts of the costs and determining whether those make sense based on your knowledge of the broker-dealer itself, but the nature of the costs. Are there new categories of costs being introduced? Things you wouldn't expect to see that are there, or things that you would expect to see that aren't there that might form a basis of investigation or inquiry with your client that could be good procedures to perform. There may be instances, not uncommon, right, for the financial reporting personnel of the broker-dealer to also have those same responsibilities for the very affiliates we're talking about, or responsibility at the parent level. So there may be access to records that describe from the parent's perspective how the allocation is working and what that starting point is, what that cost pool is that is then being allocated out across a number of entities. So if you're the auditor and you do have access to that information, it could be helpful to take that into account. And so I think there are procedures, again, but I do want to be clear, we're not putting you in the shoes of the auditor of the parent. What we're trying to do is assess whether what's happening is in fact consistent with the agreement that is probably in place, and not only in place, but likely referred to in the broker-dealer's financial statement disclosures, where it makes reference to the existence of the agreement and how that agreement and the cost covered by that agreement affect the broker-dealer's reported results. Okay. Finally, C, is the reasonableness of the methodology itself. Maybe we've determined that things are working per the agreement, everything seems appropriate. Is the allocation methodology reasonable? Well, why would we say that's potentially a relevant consideration? That is the FINRA Notice to Members 0363 concept there, which maybe some of you are familiar with that, but it's essentially saying one way or the other, it is the broker-dealer's responsibility to make a record of any expenses that are necessary for it to operate its business. And it goes on to say that one specific way of a broker-dealer accomplishing that is for there to be an allocation methodology that exists that is reasonably applied, or that is reasonable in nature. I may be slightly misquoting it there, but it's capturing this notion of reasonableness. So here we have, that's not GAAP. It's not GAAP. This is a FINRA guidance that may have, the direct effect could be on net capital if there's a circumstance where a broker-dealer may not be accounting for all of its expenses. But I don't often see that anymore. What I see are agreements that are designed to burden the broker-dealer with its proper share of its operating costs. And therefore, is that being done in a reasonable fashion or not is another consideration around this broad topic. So last point here, in my experience, there's not a significant amount of judgment or estimation uncertainty that creeps into these allocations that I see. Oftentimes they can be fairly straightforward and easy to follow, but to the degree that estimation uncertainty increases, at some point you may cross over into the accounting estimates arena, for which PCAOB has explicit audit guidance that may need to be considered. My experience would say that's not frequently occurring, but it could and may be worth a moment of time to think about when you encounter these allocations and say, hey, is this straightforward, or is there a high degree of judgment that's being involved here, which could introduce certain types of risk, including fraud, including the risk of management bias that would need to be addressed through your procedures as well. So just a bit of a word of caution there. Okay. Most of what we covered here, and there's really more, but this is an opportunity to plug one of our publications. This is our most recently issued broker-dealer audit focus document. These are short documents that are specific to topic specific. In this case, this is not just about related parties, but this one is specific to the broker-dealer industry. So you can find these on our website. I would encourage you, if you'd like to read more about this subject matter, this would be a great place to start, in addition to the standards themselves. With that, I'll hand it back to Greg.
Okay, thanks, Mike. So I'm going to talk about general financial statement areas where we've identified some, frequent deficiencies, not just in 2024, but in prior years as well. And these are areas that we look at essentially in every inspection. One is journal entry testing, and the other is evaluating audit results. And in 2024, we identified 18 deficiencies in 102 engagements related to the examination of journal entries and other adjustments for possible evidence of misstatement due to fraud. We'll go into a little more detail in a future slide. In addition, we had 16 deficiencies out of 102 where we identified deficiencies related to audit results, which essentially means we identified a gap deficiency that was not detected during the audit. So with regard to journal entry testing, we've got a list here of some of the common observations. On the left side are deficiencies, and on the right side are actually best practices or good practices that we've observed, that firms that haven't had problems in that area, some of the policies and practices that they follow that help ensure that they are compliant. So just quickly, on the deficiency side, not obtaining an understanding of financial reporting, processes and controls, not identifying and selecting entries for testing, not testing the completeness of the population of entries that were subject to testing, and not testing journal entries meeting certain fraud criteria. As far as good practices go, some of them are fairly obvious, using persons with specialized skill, particularly with regard to IT on sort of larger, more complex broker-dealers, providing firm-level guidance with examples of how that testing should be executed, training, including journal entry testing in your periodic training of staff, practice aids, developing practice aids. I think there are also some commercially available practice aids that could be used. Structured templates. And then another one that we didn't list here is software audit tools. A lot of firms are using different software audit tools to help identify outliers in the journal entry population that might be useful for selecting items to test. Mike, next slide. The guide to evaluating audit results. So these typically are exceptions that fall under AS 2810, paragraph 30 and 31, specifically not sufficiently evaluating whether the financial statements were presented in a conformity with GAAP due to apparent accounting errors or omitted or inaccurate disclosures. Two of the areas that are most frequently cited are ASC 606. We talked a little bit about some of the revenue recognition concerns we had in an earlier session, and then ASC 230, statement of cash flows. Specifically on the 606 side, where we see a number of undetected GAAP deficiencies, is matters related to qualitative disclosure of information about performance obligation, separate disclosure of revenue recognized from contracts with customers and revenues from other sources. So for example, interest income from investments is not revenue from a contract with customers, so that should be disclosed separately from the revenue from contracts with customer. And then gross versus net presentation of reimbursed expenses. With respect to ASC 230 and the statement of cash flows, there's two areas where we've seen a number of deficiencies. One is in identifying cash and cash equivalents. Some broker-dealers appear to have improperly classified certain financial instruments as cash equivalents based on the definition of cash equivalents in ASC 230 and in the glossary, the codification glossary. So a lot of it has to do with short-term investments that don't necessarily meet the original maturity, 90 days or less. Sometimes people are looking at what the maturity was as of the measurement date, as of 12/31, and saying, oh, if it's less than 90 days, then it's a cash equivalent. That isn't necessarily applicable to or consistent with the criteria. The other area where we see deficiencies in the cash equivalents is under 230, restricted cash should be included in with cash and cash equivalents in the statement of cash flows. And then there's a certain reconciliation that's required depending on the balance sheet presentation of restricted cash and cash equivalents. So we do see few broker-dealers have not caught up with that guidance. And another area where we've had deficiencies is in the disclosure of purchases and sales and maturity of certain investments. Sometimes we'll see those be presented as investing activities, but under ASC 940, 320-45-7, trading activities should be reported as cash flows from operations. Now, that could be, there are certain facts and circumstances that if the securities are held for long-term investment, perhaps maybe a different treatment might be warranted, but you have to take that into consideration, evaluate that. But generally speaking, trading activity should be reported as a cash flow from operations. So after that brief interlude, I'm going to kick it back to Mike.
Okay, so our fourth topic here is, broadly speaking, regulatory compliance. And we do kind of have this introductory slide because that is inclusive of multiple components here. The supplemental information, which I'll detail here in a moment, but also this is where we'll talk about our attestation engagement results, which Board Member Calabria did a pretty nice job of introducing the attestation requirements in his remarks. So he gave us a nice starting point there. But
not bad for an economist.
Yeah, not bad for an economist. That's right. So first, just a little bit about the scope or the frequency with which we look at these topics. So that's kind of the charts on the left side here. And if you'll recall from an earlier slide, so this is over a population of 102 broker-dealer audits that we had reviewed. In 40 instances, we took a hard look at net capital. In 22 instances, we looked at the supplemental information called for by the customer protection rule. And only highlight that because we do make risk-based scoping decisions as part of our inspections process, and it really it's not unusual at all, in my experience, to find net capital computations that seem to be a fairly low risk. There are many broker-dealers out there that carry significant levels of excess net capital as a matter of practice, and it comes through in the financial statements. So 40 and 102 times we thought there was risk worthy of inspection attention, and then in 10 of those instances we found deficiencies. The customer protection rule, so here, net capital is obvious, required for all broker-dealers. Everyone presents a net capital computation. Customer protection rule schedules, well, that really only matters if you're a non-exempt broker-dealer, and therefore you need to present a customer reserve computation and provide a schedule on the possession or control requirements. So we have two relevant schedules there, but that universe of BDs is much smaller, and so 22 opportunities to review that, and we found nine deficiencies. The right side shows the trend line year over year. Even if you looked at over a longer period of time, they tend to move up and down within a fairly narrow range. It happens to be the case in 24 that we saw a small downtick in net capital findings, but somewhat of an uptick on the customer protection side of the house. The relevant standard here is AS 2701, which broadly establishes the requirements that we'll talk about here a little bit more in a moment. Briefly, results on the attestation side, and we will spend more time here. The left side, so we have AT1, examination engagements, a small downtick year over year, but still 59%. That's certainly a high deficiency rate in our view. I think it can be explained. Happy to comment on that. And then on the review side, there are a small uptick, but essentially the same, 40-something% of engagements. And we will spend a fair amount of time exploring that and why that would be, because I think in my view, and I think frankly in the view of others, when you first see that statistic, it's surprising because it is a review engagement. We are talking about moderate assurance. It is largely inquiry-based along with some other required review procedures. So, what's behind that? What's causing that to be such an elevated statistic? And we are going to have a couple slides on that. But first, a code word, CPE code 907. 907. Be sure to get that in. And let's get into that AT2 conversation a little bit. Really some of the same data here, just establishing the 42% deficiency rate. And you may hear a little bit of repetition in my remarks, but it is for a reason, because we do think there's some easy fixes here, some quick wins that can make a meaningful difference in the results in this area. But broadly speaking, there's 3 categories of findings. And I want to introduce them here, and then we're going to explore each. First, performing inquiries, which I think most of us who do this know, they're required procedure under AT2. The particular inquiries that seem to create the most challenge are the ones involving controls and monitoring procedures, so we're going to explore that. The second category, evaluating evidence. That's kind of broad. What does that mean? What it specifically means here is taking into account what you know about the client from your audit of the client's basic financial statements and being sure that you consider that when reaching your conclusions on the review engagement. And that is a requirement in AT2 as well. Finally, auditor reporting. So the auditor's review report on the results of its review procedures.
There's some recurring errors, frankly, I don't think there's a different way of saying that, in auditors' review reports that we think are pretty easily avoidable with a little bit of extra attention. So, all right, a slide on each of those, though, because I do want to give the appropriate context. So, performing inquiries, the standard has its built-in requirements, mostly in paragraph 10. We're supposed to be inquiring of knowledgeable individuals at the broker-dealer regarding matters of relevance to the claims that the broker-dealer is making in its exemption report. Who might those knowledgeable people be? Well, certainly could be the FINOP, and I recognize there are some very small broker-dealers and larger entities. Not all of these functions are going to be represented at every broker-dealer, nevertheless worthy of some consideration. FINOPs, compliance officers, the reps themselves, who may be the point of contact for a customer, who might provide their funds to the broker-dealer via the rep, inter-audit personnel, other executives. So give consideration as to whom you should be inquiring of. And there are some basic inquiries around, to your knowledge, did the broker-dealer comply with the exemption provisions during the year? Do you have knowledge of feedback from other regulators, FINRA and the SEC, that is relevant to what the broker-dealer is asserting in its exemption report? It's a sort of litany of required inquiries, and for the most part, we think teams do a perfectly fine job of following through on those. But then it gets a little more specific around controls and monitoring procedures. Well, controls and monitoring over what? Well, compliance with the exemption provision, or maybe provisions that the broker-dealer is claiming in its report. And there just continue to be a number of circumstances where we get involved in the inspection. There may be an indication in the checklist that, yes, I made inquiries of party X regarding the broker-dealer's controls and their monitoring procedures. Okay, well, that's a starting point for me as an inspector to try and understand what those controls and monitoring procedures are. And it's just far too often the case that engagement teams can't articulate what those controls may be, nor are they documented, nor are they even referenced from the AT2 work into perhaps other areas of the file where they may be documented. And so that really calls into question whether the purpose of the inquiries was satisfied through the work that the engagement team did. So I won't minimize this and say this is entirely a documentation matter. I don't think it is entirely, but I think it may be in part. And so I would encourage everyone to take credit for the inquiries you're doing, of whom you're inquiring, and what those responses are, which would need to be specific. What is the nature of the control that's relevant? The frequency of that control, and is there monitoring of whether that control, or perhaps 2 or 3 controls, is also taking place. And I certainly accept the fact there are, again, small organizations for which there are not going to be numerous controls that are specific to the subject matter of most commonly prompt transmittal of customer funds. That's 9 times out of 10 what this is coming down to. What controls does the broker-dealer have in place to ensure that funds it may come in contact with from customers are in fact properly transmitted, promptly and properly transmitted under the rule? So we need to see some improvements, the word I would use, from firms in evidencing their work in that area. Again, notwithstanding the fact that we understand no 2 broker-dealers are created equal, and the nature of those controls is going to differ in terms of frequency, complexity, the nature, the sophistication. There's a wide range of outcomes that are certainly reasonable given the wide range of broker-dealers that are there. Okay, evaluating evidence. So then this is, again, the core requirement to take into account what you know about the client from your audit when concluding on the review. And there's really one scenario that's also the most commonly encountered here on our inspections. And generally speaking, we're talking about that broker-dealer that claims K2II exemption. And what does that exemption say? Well, it says I have a fully disclosed arrangement with a clearing broker, and any customer funds or securities that I may encounter are in fact promptly transmitted to that clearing broker in accordance with the rule. Great. Okay. Fine. Many broker-dealers claim K2I out there. A lot of introducing brokers exist. Then we look at the audit because we're looking at different financial statement accounts. We're reviewing the planning, risk assessment, your understanding of the client, and there seem to be indications that the broker-dealer conducts other securities businesses. What I mean by other, I'm using other to represent businesses for which the clearing broker has no role or responsibility. Most of the time, this is some form of a direct relationship with one or more mutual funds or fund sponsors, a direct mutual fund business, or perhaps an arrangement with insurance companies to sell or distribute insurance products, variable annuities, and the like. And those are securities businesses too, and a lot of times the broker-dealer's exemption report doesn't seem to account for those businesses. There are customer protection risks associated with those businesses as well. And so that should prompt the auditor to respond, to at least ask questions and understand the broker-dealer's point of view. Why am I just claiming K2II in this instance, where there's some other risk that seems not to be addressed? At least on the surface, based on what may be in an audit file, speaking as an inspector, that we might be able to see. So important to take into account everything you know. I don't think broker-dealers have any vested interest in kind of mischaracterizing their business in an exemption report. I don't think that's what's going on. Maybe there's a lack of understanding of what's expected on their part in terms of what they assert in their exemption report. But this does continue to happen with some frequency. Reporting on the review engagement, I do think at some point an element of due professional care may be behind some of these instances, but a couple of things can happen here. Broker-dealers have to make certain required assertions. They're outlined in 1785 and reiterated in AT2. Sometimes those simply don't appear in the broker-dealer's exemption report. But nevertheless, the audit, you look at the review report, and the review report's giving them credit for an assertion they didn't make, or there's no investigation around or acknowledgement that the broker-dealer didn't make a required assertion and getting that resolved. The other category here is sometimes you read this is what I always do. I look at the review report and the exemption report side by side. And when you get to the portions of those respective documents that describe the broker-dealer's business, they really ought to be the same. And there are instances where, I'm paraphrasing a bit here, but where auditors are basically putting words in the mouth of the broker-dealer, saying things about the broker-dealer's business that it's limited to X, Y, or Z, when the broker-dealer made no such statement in its exemption report. That really shouldn't happen either. You're reporting on identified assertions that the broker-dealer is making. So the starting point are those statements that the broker-dealer chooses to make, recognizing certain statements are in fact required. So keep all those concepts in mind as you conduct your review engagements.
I think the reason we see that more often than any is firms are just using a template, which is oftentimes from another client or from another broker-dealer that they looked on Edgar and pulled down without really thinking about the applicability of that report to their particular client's facts and circumstances.
That's right.
So my point being is it's probably the most avoidable deficiency that we see.
So we'll keep hammering these points home in hope of driving down that deficiency rate. Code word 471. Hopefully you saw that on the screen, but we'll give it just a moment here. We've got a couple other topics to cover in our remaining 10 minutes, but I think we're going to be good on time.
So 471, this does give me a chance to plug the other broker-dealer audit focus. The first one we published was focused on AT2, and it was published last September. You can find it on our website. I forgot, I do have some scenarios. Okay, let's reinforce these concepts quickly. Here's a quick scenario. Okay, broker-dealer claimed K2II, said it was compliant with K2II throughout the year of 25. During its revenue audit procedures, the auditor identified that the broker-dealer recognized revenue from the following sources: an introduced business on a fully disclosed basis, sales of variable annuity products to customers, and fees from placement of customers in an unaffiliated private investment fund. Okay? So here we go. Which of the following statements best describes the auditor's responsibilities under AT2 regarding the K2II exemption? Well, the auditor doesn't need to consider the evidence obtained from the audit. Okay. B, because the introducing broker cleared securities transactions with the clearing broker on a fully disclosed basis, the auditor doesn't need to perform additional review procedures. C, the auditor should evaluate whether the variable annuity and private fund placement services contradicted the K2II assertion. Or D, the auditor needs to test the operating effectiveness of controls over the private placement business.
Any questions?
32, we'll give it another couple of seconds. Okay, looks like we've stopped there, and good. We're listening well. 89% C. This is the point we were just making, that, hey, be on the alert for the notion of contradictory evidence, typically in the form of other securities businesses that aren't involving a clearing broker. We have one other quick scenario. This one's on reporting. Okay, the broker-dealer disclosed in its financial statements that we clear transactions on a fully disclosed basis through an unaffiliated broker. Maintain a special account for the exclusive benefit of customers in connection with securities businesses not cleared through the clearing broker. We don't carry accounts, we don't perform custodial functions. The broker-dealer's exemption report said it claimed exemption under K2I and K2II, and that it also met the identified exemption provisions throughout the year. So here's our question. Which statement would be inappropriate for the auditor to include in its report? Management is responsible for compliance with the exemption provisions. That's A. B, the broker-dealer identified K1 and K2II as the provisions under which it claimed exemption. C, a review is less in scope than an examination, the objective of which is to express an opinion, so we're not going to express an opinion in the review report. And D, we're not aware of any material modifications that are needed. Okay, so which one of those would be inappropriate? People still thinking? I may have shorted you slightly on time. That's my apology. I spoke too soon. We'll get there though. All right, 31, let's give it a few more seconds. See how we did here. It all hinges on one specific, it's close, horse race. Okay, 41% of you picked up on the distinction between K1 and K2I. That was probably unfair. The purpose of this is K1 is a limited purpose broker-dealer exemption. It basically says I'm distributing mutual funds or certain insurance products and I don't do anything else. So if you see a broker-dealer claiming K1 alongside something else, we have a problem. We got to ask some questions because those shouldn't coexist. K1 says that's all I do. So
little bit of a trick question, unfair, but it does happen.
Well,
Greg?
and if you have a broker-dealer that does a mutual fund or insurance business in addition to a cleared business under K2II, then they should probably be looking at footnote 74, or
Yep.
perhaps maybe in certain circumstances K2 single I. But you can only use the K1 if that's the only thing the broker does from a securities business perspective.
It would be nice if 3.3 paragraph K were updated to be more reflective of the current types of businesses out there in the industry, but that's not the mode we're in right now. So we have to deal with some of those realities of the rule itself. I need to leave Greg 5 minutes, so we're going to be brief on AT1 here. A 59% deficiency rate's what's on the screen. A lot of AT1 deficiencies are grounded in the ICOC portion of that standard, which is testing controls, right? So testing controls can involve a lot of considerations. There are many financial responsibility rules that are within scope for AT1. So if I'm trying to put the 59% in context for someone who's not familiar with this area, I say there really are a lot of opportunities for things to go wrong on an AT1 engagement that partly accounts for this elevated deficiency percentage. But I won't go through the litany of deficiencies here, but I would say, broadly speaking, on controls, a lot of controls are management review controls in nature. So what we're typically looking for there is a good understanding around the nature of the control, the relevant thresholds that may exist, and how management identifies, investigates, and resolves matters that appear to be out of sorts or out of balance, whatever the case may be. And then the second most common topic here is controls that they themselves are dependent upon information, a report out of a system. See a lot of this in possession or control or customer reserve, a deficit report, a stock record allocation report. Well, that report needs to be reliable for the parent control to work. So what are the controls that are ensuring the reliability of that information is another broad consideration. Okay, I know that was a little bit rushed. I'm going to hand it back to Greg to wrap us up.
Yeah, I'm just going to wrap up. I want to touch on 3 areas that we see deficiencies. Now, these are areas that do not relate directly to the sufficiency or appropriateness of evidence obtained to support opinions. This includes auditor communications under AS 1301. We had 21 engagements and deficiencies there. Some of that is around the fact that a lot of the smaller broker-dealers and even some of the bigger ones don't have an audit committee as you typically think of it, but the standard contemplates that and does provide for those communications to be made to an equivalent or those charged with governance. So we just want to make sure people are thinking about that. Another area is in identifying and assessing risks of material misstatement. Under 2110, we identified that. In 19 instances, a lot of this has to do with making the required inquiries, including especially, I would say, maybe inquiries of others. I think most people in firms do a pretty good job of inquiring of, say, the CFO, the CEO, but when there's a requirement to make inquiries of the audit committee, if there exists, or the equivalent, but also others. Now, a very small broker-dealer may not have anybody that is an other, as you would think about it. But if you think about your typical introducing broker-dealer, there are registered reps, for example. Those would be a good candidate for somebody to have those kind of discussions with. So we just ask people to think about that. And then the last area is auditor independence. The good news here is we're not referring to firms preparing the financial statements. We really don't see that anymore. What we're talking about here is really the communications that are required under Rule 3526, which is the annual affirmation of independence. But also, some firms don't really have good procedures to make sure that their employees are in fact independent of their clients, and so we do have some concerns there. The next, we have a quick code, 979. While you're writing that down, I'll just tease the next slide, which is a list of our PCAOB.
979.
publications that are available and can be of great assistance in helping you execute your audits. When we started this, say before the pandemic, that list was 2 items, which was basically a 2014 staff guidance and our annual report. We've added a supplement to our annual report, and we've issued about 7 or 8 different focus areas. Some are specific to broker-dealers. We touched on a couple today, the related party one and the AT2 one, and some are broader to audits in general, which would be relevant to issuer clients, your issuer client business as well. And then our last slide before the end here is just an update on where we are on selections. So for 2025, or excuse me, on inspections, so for 2025, they're complete. We're in the process now of aggregating our findings and drafting our report. We expect that to be issued in sometime in June this year. As far as 2026 inspections go, we've made our selections for this year. We actually have been in the field on a small number of inspections the past few weeks, but we're still in the process of notifying firms, and that process actually, for a number of different reasons, including timing and archiving and things like that, can drag on into the late summer. So if you haven't heard from us, that does not mean that you have not been selected for inspection. And you probably really can't breathe easy until maybe beginning of October, and even then,
Wow.
But so that will continue on. And then lastly, we're really at time, and we're up to a break, so we don't have time for questions. I don't know if any came in.
But I do want to acknowledge the one question we did receive that is grounded in one of our scenarios, but involves recent amendments to PCAOB standards. I don't know who asked the question. I have to think about this before I answer it. I like the question. I'm going to ask that person, listen to our standards update. And then if the question, you still have that question, come find me in the back. We'll have a chat about it. I want to think about this one a little bit. It's a good one. So thank you.
Yeah,
thank you for
Mike and I
that.
will be here for most of the day, so
Yes.
please feel free to grab us and ask a question, and we appreciate and thank you for your time.
Thank you.
Take care.